Hi, I'm Max Keiser. This is the Keiser Report. Markets, finance, and all the scandals that are ripping the global economy apart and causing a new wealth and income divide around the world and a new neo-feudal model of economics that, well, reminds us of the old Middle Ages model of economics. Stacy Herbert, what do we got?
Max, first we have a follow-up from last week's Keiser Report where you discussed financial pornography with Luc Saucier. Here's a headline from the Huffington Post's Janet Tavakoli. Should taxpayers continue to subsidize Goldman Sachs' alleged obscenity? So Janet Tavakoli is the author, of course, of Dear Mr. Buffett. And I wanted to highlight a comment from Sundog58. He says, laughing out loud, Goldman Sachs and JP Morgan are the kiddie porn of the banking industry. Watch three pubs and the conserva-Dems squirm in their seats when the public realizes their campaign benefactors are pornographers.
Exactly. That's the beauty of this concept. It immediately shot to the popular press. Nobody wants to be painted with the kiddie porn brush. If you can say Goldman Sachs and JP Morgan are committing financial acts of financial kiddie porn, the moral equivalent, you will get immediate response from Congress to shut them down, and the kiddie porn, financial kiddie porn risk on their balance sheet would have to be discounted, which in Goldman Sachs' case means a current stock price of zero.
But speaking of pornography, Max, here's a headline from the blow-up doll of global finance. Yes, the IMF, like a blow-up doll, is telling us our GDP is huge. IMF hikes global growth forecast, shows U.S. leading the developed world.
That sounds like disingenuous comments from the IMF. Tell me more.
Well, apparently the IMF says it's bigger than they thought it was going to be. They hiked their 2010 global growth forecast to 4.6% from 4.2%. And they say that the U.S. will grow by over 3%.
Well, if I told you my GDP were enormous, would you go along with that? Or would you somehow interfere with some other logic?
Well, this blow-up doll, of course, is programmed to tell certain nations that their GDP is actually smaller than what it is in reality. But in this case, I want to look at some headlines that actually might suggest that our GDPs are a lot smaller than what the IMF is telling us and shrinking.
That's so tragic. Somebody call Dr. Freud.
Headline reads, Fed to the rescue. With Congress checked out, Federal Reserve considers ways to goose economy.
Wait a minute. I thought that they already said the economies were growing. Now they want to goose the economy? Oh, I see. They're lying.
So basically they're saying that the Federal Reserve is going to introduce Viagra to a situation which is already growing according to their records.
It's called Dr. Freud. That's who you need to understand this global economy. It's remember, economics is a soft science. It's not a hard science like physics.
No pun intended. So the next headline to go along with proving that the IMF is lying to us, EMU breakup risks global deflation shock that would dwarf Lehman collapse, warns ING. So this is ING Bank, the Dutch bank, is saying that a full-fledged disintegration of the Eurozone would trigger the worst economic crisis in modern history, devastate every country in Europe, including Germany, and inflict a deflationary shock on the U.S. There will be no winners, they say, in a new report quantifying the unthinkable.
That's nonsense. And let me explain something. There is not going to be that effect on the Eurozone because the Eurozone has Germany, and Germany is an economic powerhouse. Furthermore, if there was a huge deflationary collapse in the United States, well, think of the benefits. No more funding of the Iraq incursion, no more funding of the Afghanistan war, no more funding of the Iran talk and saber rattling and potential invasion. You get rid of the United States economy, you get rid of the worst warmongering, fear-mongering, Pentagon-centered, irresponsible, Hillary Clinton-driven, geopolitical, risky malcontents, and you could actually have a huge benefit if, in fact, you took the dollar down to zero and took this country offline.
Well, ING is basically arguing against Greece defaulting in particular. And some are arguing against that, saying, look what happened to Argentina, that in fact, by Argentina going bankrupt, defaulting, they got themselves out of a deflationary spiral. But certain people don't want them to be able to grow their GDP.
Yeah, well, because the bankers love to keep the status quo going and to keep inflating with phony money because they pay themselves these huge bonuses, and then they use every possible means at their disposal to pull up the drawbridge. And everybody who's not a partner at Goldman Sachs is left to face down in the mud.
But ING here could just be talking their book. They could be the ones that will lose the most if Greece defaults. Because check out this next headline, Max. European banks use gold reserves to raise cash. According to the Financial Times, European commercial banks have begun using their holdings of gold to raise cash with a bank for international settlements. The BIS, the so-called central bank's central bank, took 346 tons of gold in exchange for foreign currency in swap operations.
Yeah, well, this is remarkable because the countries are getting rid of the only thing on their balance sheets that has any unimpeachable value, gold. And they're swapping it for treasury bills and other fiat currency so that they can stack up this global Ponzi scheme of derivatives and to perpetuate this model of trying to get something for nothing. Reread Milton Friedman. Didn't he say there's no free lunch? And yet this is what all these bankers want. They just want a free lunch every single day by issuing more and more, many trillions of dollars worth of worthless fiat paper.
Just to be clear on this is a situation similar to a pawn shop operation. So these in the gold swap, one counterparty, in this case a bank, sells its gold to another, in this case the BIS, with an agreement to buy it back at a later date. So if these countries or these banks do not default, the BIS will not be taking this gold.
That's right. And they're going to default because they're involved in a deflationary spiral, because they're going to create more debt with the loan value of the gold that they just gave up. So it's almost a guaranteed. If you put a gun to your head and you pull the trigger, the chances are you will blow your head off. If you substitute gold for fiat paper and then leverage that up to 10, 20, 30 to 1, you're going to blow your economy up. It's not a big mystery here.
I might add that this is very similar, again, to the first Great Depression or the last Great Depression, in that during the Great Depression of the 30s, much of the sovereign wealth of the world made its way to Switzerland. So it's interesting that it's once again going to the Bank of International Settlements, which is in Switzerland. So who knows? We don't know which nations or which banks in which nations actually are selling this gold or swapping this gold with the BIS.
Right, and it all goes back to Switzerland, as you said, and we've seen this movie before.
And further on this Great Depression theme, China won't dump U.S. treasuries or pile into gold. And we saw many of these sort of headlines during the first Great Depression where everybody's pretending everything is normal. In this case, the State Administration of Foreign Exchange, otherwise known as SAFE, in China has ruled out the so-called atomic weapon of dumping its U.S. Treasury securities worth $2.45 trillion and called on Washington to be a responsible guardian of the dollar. According to China Daily, the SAFE described Beijing as a responsible long-term partner and doesn't seek the power to control recipients of its investments.
They're lying.
But it's interesting that they've actually introduced into the equation, and they've publicly addressed this notion that they're seeking to control the U.S. via all their investments in the country.
Right. The language is kind of subtle there. They're saying, like, we believe that our ability to continue to control the American economy will be in place enough that we will not be forced to sell our dollars and increase our gold supply. Oh, by the way, if you act up in any way that we find intolerable, we will dump our U.S. treasuries and we will be buying gold and we will collapse you to the mat like George Foreman in a fight where you're lying on the ground puking up your guts.
In the online world, this sort of statement and this announcement from China would be considered a concern troll. They're pretending to be concerned about this nation.
A concern troll,
thus raising the possibility that they could actually do this.
That's the online speak you're talking about. Yeah. The troll. I see. They're purposefully inserting themselves in a way that is, you have to understand this with double meaning. Double meaning. Yes.
And now, finally, on this notion of another Great Depression, this is another theme that is similar to the first, and that's scapegoating. Blame the unemployed, reads the headline. Senators describe jobless as lazy or drug addicted. Senator Orrin Hatch, Republican from Utah, proposed drug testing the unemployed in America. He said, quote, a lot of people are saying, hey, it's about time. Why do we keep giving money to people who are going to go use it on drugs instead of their families?
The unemployed in America are the new Indians. And these congressmen are going to try to put them onto reservations. And they're scapegoating the Indians, and they say, oh, why give the Indians, remember, go back 150 years, why give them any kind of money? They'll just buy booze. In America, they're saying, why give these people jobs? They'll just buy drugs with it. Let's put them on reservations.
But, Max, I think more importantly, this issue here is that the welfare payments and transfers to the banking sector, as we started at the top of the show, the financial pornography, the obscene act of transferring trillions of dollars to bankers has happened. Trillions. And yet, here's Senator Orrin Hatch saying that the little guys are the ones that are drug addicts, not the Wachovias and Wells Fargo, who just a week ago we covered have pled guilty to laundering hundreds of billions in Mexican drug cartel money. So you could read his statement. He says, why do we keep giving money to people who are going to go use it on drugs instead of their families? Well, why do we keep giving money to banks who are going to go use it to launder Mexican drug cartel money instead of using it for the economy?
Yeah, of course. I mean, this is what Orrin Hatch should be talking about on the floor of Congress. The proof is now in the public domain. Wachovia, now part of Wells Fargo, laundering hundreds of millions of dollars for Mexican drug cartels. They have not admitted or declined guilt, but they're paying a fine, which we all know is code for, oops, you caught us. Here's some money. Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
All right, stay tuned. Plenty more coming your way, so don't go away.
Every month, we give you the future. We help you understand how we'll get there and what tomorrow will bring. The best in science and technology from across Russia and around the world. Join us for Technology Update on RT.
Hungry for the full story? We've got it firsthand. The biggest issues get a human voice, face to face with the newsmakers on RT.
Welcome back to the Keiser Report. Time now to go to Florida and talk with Carl Denninger, who runs the blog marketticker.org. That's market-ticker.org. Carl, welcome to the show.
Hey, how you doing, Max?
All right, Carl, in the middle of the night on July 4th and early July 5th, you made a video of market manipulation happening live. Tell us more about what you saw. Describe what we're seeing. We're going to play that video behind us as you speak.
All right. Well, this is a practice that goes on in the S&P 500 pits and in the Globex essentially every day, but it is usually pretty well masked and difficult to kind of suss out from the regular market activity. And, of course, the people who are pulling this sort of game like it that way. On the overnight on the 4th, the volume and the liquidity was so thin that the game kind of came out to the fore. And I'm rather surprised that our little pals that play this game continue to do it where it was so visible. But they made it very obvious to anyone who cared to look. And essentially what happens is these guys come into the market, and these are not small players, all right? You have to have about $10 million worth of margin available to do this. So you're talking about banks, you're talking about big hedge funds. And they will place an order, for example, to sell an S&P futures contract, maybe 20 or 30 contracts, maybe 100 contracts, and then they will show up on the other side, on the bid side, with huge numbers, 2,000, 3,000, that they never intend to be executed. And the intent there is to scare other people in the market into taking the opposite action. So you see all these people that are going to buy, and you go, oh, the price is going to go up. And so you buy a few contracts, and the next thing you know, the price gets slammed in the other direction. It's an attempt to scalp off fractions of a cent. Okay, these guys are not after 2% moves or anything like that. They're looking for 0.1%, 0.20%. It's all a game, but the point is it's illegal. It's been going on for 20 years. I mean, ever since I've been a trader, I've seen it to one degree or another. But on the 4th and the 5th, I got the opportunity to show it to people in a way that was absolutely unmistakable in terms of exactly what was being done.
All right, let's talk a little bit about this some more and the mechanics of it, because typically what goes on in the market making on a security, the buyers and the sellers show up, then there's a determination as to whether there is an imbalance of orders. If there's more buyers than sellers or more sellers than buyers, you will see an uptick or a downtick corresponding with that imbalance of orders. And now what we see on your video quite clearly is that an order comes in that is 20 times bigger than the action happening on the exchange at that moment, a 2,000 lot order, and it's only there for a fraction of a second to get the market-making mechanism to interpret that as an imbalance large enough to create a downtick or an uptick. And this is basically, it's important to keep in mind here that the order that was put into the mix to create this artificial price is immediately subtracted. So this is immediately withdrawn. You only see that order for a fraction of a second, and it's just there to manipulate the price. Is that correct?
Yeah, there's no intent for that order to actually execute. In fact, if whoever's doing this is unlucky enough to have that order really go through, then they're going to get stuck way off sides compared to what they were intending. So the only way to do this is with high-speed computers. You as a home player or you as an investor that is somewhat disconnected from the market like I am, I'm 1,500 miles away from New York. By the time I could transmit an order to do something like that from my desk here in Florida up to New York, have it show up in the order stack, and then take it back down again, there's a very high probability that I would be executed. The computer that is sitting at the exchange, on the other hand, can do all of this in a fraction of a second. And normally, the market is busy enough that these games get lost in the noise. You don't see them as clearly. But when we had a market that was so thin, trading on holiday hours like we were over July 4th, it was just blatantly in your face. And you could see what is done literally every day as an attempt to send false signals to the marketplace.
Right. Now, in the Financial Times, I read stories that say that new market-making companies want to set up and co-locate servers next to exchanges to give them access to these prices to perform exactly what you're talking about, which is not to add liquidity or to do anything that's economically viable in any way. It's simply there to scalp markets and to manipulate prices. And yet it's treated in the financial press as if this is a normal thing, that you've got these hyenas who want to set up shop next to the exchanges and siphon off hundreds of millions and probably billions in cash. It's not an economically viable thing that they're doing. They're just stealing money. Isn't that so?
Well, essentially, yeah. I mean, each of these ticks in the ES futures, in the Globex minis, is a quarter of a point. So if you have right now the S&P around 1,000, 10 points is a 1% move. And so you're talking about these guys trying to grab literally fractions of a penny in front of a steamroller. The problem with what's going on here is that they are inserting themselves in front of the customer, and this is not supposed to happen. We're supposed to have a fair and orderly market. If I put an order in and there are 100 people in line in front of me, I'm supposed to go to the back of the line. But what these hyenas will do is they will stick an order out there that they have no intention of having actually execute. They'll put 5 or 10 of these things out there because they can cancel those orders faster than anyone else can react. So you've got people essentially, think of it like when the iPhone went on sale, you had people that were paid to stand in line to take other people's place. And essentially that's what's going on. But instead of these people standing in line to actually buy an iPhone, they're standing in line and then all of a sudden they all disappear and this supposed demand for this device collapses. Well, that's the same thing that's going on here in the markets.
Okay, now two additional points here. First of all, as you point out, this is a game for people with $10 million credit lines. And
right.
One of the things about the credit lines, thanks to artificially cheap, some would say, rates by the Federal Reserve, is that the cost of borrowing funds for these hyenas, for these market manipulators, is incredibly low. I mean, it's basically their cost of funds is close to zero, number one. And number two, as we've learned from the 2008 crash, when a big firm is engaged in this market manipulation and fraud and wealth confiscation and market manipulation, when they get in trouble, the governments bail out their fraud. Can you speak on those 2 points?
Well, yeah. I mean, one of the problems with this sort of thing is that, first off, a credit line is not drawn credit. Okay, so the fact that these firms have $10 million worth of available margin doesn't mean that they have to actually pony up $10 million actual dollars, which of course is a problem because they're out there representing themselves as, as presenting this liquidity to the market. The liquidity is false. It doesn't actually exist. And if those orders were intended to be executed, then that would be actual market liquidity. But they're not, and they don't. And so what you have is a market that has 70% of its volume comprised of these guys, and yet what you see in the marketplace when that 2,000 contract order shows up is a intimation that the market has the ability to absorb 2,000 orders, 2,000 contracts of order at that particular moment. This is not true because instantaneously that order disappears. So if you act on this and you believe that these things are real, then you will make bad decisions. And that's essentially what these folks are trying to do. They're trying to drive people to commit what amount to forced errors.
Okay, so let's talk about an appearance by Lloyd Blankfein, who was interviewed by Charlie Rose on PBS in America. And Lloyd Blankfein, CEO of Goldman Sachs, was making the case that, well, all this high-frequency trading and all this front-running that they do is really a necessary addition of liquidity to the system and necessary market making to the system. Based on what we're saying here, he misspoke. Is that accurate now?
Well, I'd go further than that. I'd say he's lying, but that's my opinion. Look, liquidity and volume are not the same thing. If I have two computers that pass 100 shares back and forth between each other 1,000 times, it looks like there's 100,000 shares of liquidity in the system. There isn't. There's only 100 shares of liquidity in the system, and the first person that shows up with a 10,000 share order is going to find that out the hard way. So this is the fallacy that goes along with all of this, and that these guys all claim to be adding liquidity. They're not. They're adding volume, and that's not the same thing at all. There's a huge disconnect here, and frankly, I don't believe it's an accident that these sorts of statements are made, because I don't believe that Lloyd Blankfein is ignorant of what's really going on and what he's doing.
Well, clearly, if the amount of volume on these exchanges and the percentage that Goldman is involved in these transactions are compared with the underlying economics of the United States and the GDP of the United States, you find a huge disconnect, because there's no way that a GDP of, let's call it 12 or 13 trillion would support hundreds of trillions of dollars or more. Actually, if the total volume of these bogus derivative trades is in the quadrillions. So there's no connection at all between the underlying activity of the country and these bogus fraudulent schemes on Wall Street. Now let's go back to May 6th, the flash crash, as it's called. Is this basically an extension of this concept, Carl Denninger?
To some degree, yeah. Essentially, what happened in the flash crash is that you had actual orders show up into what was believed to be a liquid market, and all of the computers pulled their bids. And so as a result, you had the reality of the illiquidity of the market that suddenly asserted itself. And this is the danger in believing that you actually have liquidity that is generated from these high-frequency trades. This is the falsification, if you will, of the assertions by Blankfein and others, in that you say, well, we have all this liquidity that's added by these people. Well, where was it on the day of the flash crash? The fact of the matter is people came in to sell, and there was nobody to buy. There was no liquidity. It didn't exist. It instantaneously disappeared. The entire point of these systems is to try to get in front of other people's orders and try to get in front of trends. Some of it is blatantly illegal, some of it is not, but all of it operates simply by essentially being an arms race. It's the old premise, if I buy a gun, you're going to buy a bigger gun. Eventually we get up to buying nuclear weapons, and yet if one of us starts to shoot, we find out whether or not the other person is actually, does have what he represents to have. And as we found out in May, with the flash crash, the answer is no. The liquidity doesn't really exist.
Right. And the arms race in this case would be computer power and speed as it relates to market making. And when Blankfein talks about liquidity in market making, he's lying. I would agree with you on that, having designed some of these systems myself. Let's move on to the IMF. They say that world growth is going to be better than expected, 4.6% instead of 4.2%, and that the U.S. will be leading the developed world with GDP growth of 3.25%. Carl Denninger, put on your macroeconomic hat for a second. Are things booming down there in Florida?
Oh, you got to be joking. I mean, I saw that report this morning. It's a laugh. The thing that I don't understand with these guys is they run around and they start talking about real GDP growth. Our government is spending 11% of GDP beyond what it takes in taxes. That's where all of this so-called support and so-called growth and so-called economic recovery has come from. Sure, hey, listen, as long as I can get people to take my rubber checks, I can look like I'm spending like a king. The problem is the checks are rubber. At some point, I have to cash them. And I don't know how long the government's going to be able to continue to do this. We are benefiting at the present time in the United States from a fear that Europe is essentially going to collapse. At some point, that's either going to become recognized as the fear becoming the reality, or it's going to be recognized that that was a bunch of bull. Either way, this ability for the federal government to turn around and borrow at essentially zero is going to disappear. So the idea that we can continue to run 11, 12% structural deficits of GDP on an indefinite forward basis is a joke.
Well, Goldman can always sell collateralized tarball obligations and save the economy. Carl Denninger, thanks so much for being on the Keiser Report.
Thank you.
All right, and that's going to do it for this edition of the Keiser Report. I want to thank my guests, Stacy Herbert and Carl Denninger. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, this is Max Keiser saying bye, y'all.